Right, 11 o'clock. So good morning, everybody, and welcome to the show. So as usual, I've got some news to run through, and then my guest this week, something slightly different from the ordinary. We're going to be talking to Richard Stone, who's the Chief Executive of the AIC. So I'm sure you've got plenty of questions for him. If you do, please put them into the YouTube chat box, and I will relay them to Richard. So news first. Three things that I pulled out. They're nothing particularly massive, but I just wanted to talk about Temple Bar first. It's a stock that we've written on and will continue to do so for a while. And one that I like quite a lot, actually. It's a chunky size, 850 million, trading at a relatively narrow discount, which is obviously good news, and a reasonable dividend yield, but we'll come on to that in a second. The results for 2024 are very good, and you can see those there. So the NAV and the share price were well ahead of the all-share benchmark, over sort of 11%. And actually, that's carried on going into 2025, even though the market's changed a bit, and that's quite encouraging. So we've got actually 6%, or more than 6% outperformance for the share price over the all-share so far in 2025. And since the Red Bull team took on the trust in October 2020, so we're sort of 4.5 years in, it's returned more than, well, yeah, I think more than double the return on the all share, which is great news. And unsurprisingly, given all of that, when you rank the UK equity income sector by 5-year NAV returns, it comes out on top. Despite that, is that it had sort of struggled a bit in the 6 months before they took the stock over. So very good news. I'm sure a lot of people will be quite happy with that. But if you rank it by dividend yield, then it comes out fairly low, so down towards the bottom. And there's a good reason for that. When they took the trust on, or around the same time, the board took the decision to cut the dividend by 25%. Now, obviously, that's not something that you do lightly with a UK equity income trust, because it wrecks your track record for things like the dividend hero stuff. And so it was quite a big decision at the time, but the board felt, and I think new managers agreed, that it was trying too hard. So although that dividend in 2019 was covered, it was a real struggle to get there, and that was affecting the performance. So they wanted to bring the target level of revenue generation down to try and match the expectations of what they could do in terms of total returns. Then in 2020, we had COVID, and obviously that meant a massive great hit to the revenue, which you can see in that pink line there. So the dividend cut you can see down there, but that was a lot of that came from capital, and the same was true in 2021. It still wasn't quite covered. It was covered in 2022, not quite in 2023, but by the time you get to 2024, the dividend is actually ahead of where it was in 2019 when it was cut. So they have been growing it quite substantially all the way through, and it was covered by earnings. So that's obviously good news. What they've decided to do, and actually I think I really quite like this, so a lot of trusts have said we will pay out an enhanced dividend based on a percentage of NAV. So there might be a percentage of NAV at the end of the year, it might be a percentage of NAV at the end of the quarter. So 4%, 6%, there's plenty of different examples of this. What Temple Bar are doing instead is they're going to top up the whole dividend by 3p per year, and they're going to do that in quarterly chunks of 0.75. So it's a fixed amount. So you'll get the normal underlying dividend growth plus the top up, which is obviously coming from capital. And so that should mean that even if the NAV goes down, they should be able to keep the dividend progressing, which is obviously, if you're investing for the income, is going to be very good news. And the rationale for doing that makes perfect sense as well. So they're saying, we're seeing a lot of companies opting to buy back stock rather than raise their dividends. And we're not unhappy with that, because it makes perfect sense for them to be buying back their stock while their share price is depressed. We know the UK market is probably valued too lowly. And so they're very on side with this, and this makes perfect sense, and it makes sense to me too that they're going to do that. So if you wrap all of that up, just topping up what they paid quarterly last year with that extra thing, they're going to project a yield of about 5%, which will bring them much higher up in that table. So all good news. Harmony Energy Income, less of a good news story. We can see there on the chart with the NAV and the share price peaking back in 2023, and then everything sort of the wheels coming off as they struggled to generate their portfolio wasn't quite finished yet, but when the other battery storage companies said we were struggling to generate revenues in the UK, that obviously affected sentiment, and also we had the general widening of discounts while interest rates were going up. What the board did is say, look, this isn't sustainable, we're going to have to do something about this. And so they basically said, we're going to sell the assets off. And I think there was sort of jury's out type situation, so that the share price moved up a bit, but not a lot, because people weren't sure what the batteries were really worth. And so this bid from Foresight Group is actually quite good news for that. So they're saying 84p a share, which is a decent premium to where the share price was before they announced it. It's a very big premium to where the share price was before Harmony said, oh, okay, we're going to give up and sell the assets off. It's still a 9% discount to NAV, but that's reasonably tight. There was a competing deal on the table, and so this is not a done deal yet. Foresight haven't actually made the bid yet. They've just said that they'd like to do it. The board have said if Foresight do press the button, then we are going to recommend it. And actually 12% of the Harmony shares have been committed to voting in favour of this. But talks are still ongoing, so this is not a done deal by any stretch of imagination. But it does mean that it's a mark in the sand, and it could be that somebody comes along and tries to top it, or it could just be that it goes out at that kind of 9% discount. Now, obviously, the read across here is for the other battery storage companies, Gore Street and Gresham, which are still trading on enormous discounts. And the sort of Harmony discount there of about 15 is reflective of the uncertainty that the bid's actually going to definitely materialize, but I think that will just sort of tick up once it does. But given that line in the sand, you'd think that the other two share prices would respond, but I've been saying this in all sorts of situations, all sorts of bids, and it hasn't happened yet. We do have that other potential catalyst for re-rating in Gore Street, in that they are waiting for the tax credit money to come through for their US battery assets. And when that does come through, that should be a big chunk of change, which they can then use to buy back stock if they want to. So we shall see. Lastly, Chelverton. ZDPs are a bit sort of forgotten part of the market yet at the moment. But, we wouldn't mind to see more of these issues in future. Chelverton have been using for a long time. They just regularly issue new ones when the old ones mature. And so the 2025 zero is obviously maturing any minute now, actually end of the month, end of April rather. And so they are going to launch a new one, 15 million shares at £100 a share. Initially as a kind of rollover for existing holders, but to the extent that those aren't taken up, then they will be placed for their investors. So issued at £1, mature in January 2031, and redeemed at 151.63. So you just get a nice steady accumulation of value all the way through up until the end date. So the redemption yield on that is 7.5%, which is fairly high for borrowing costs. You think if you borrow at the moment, you pay SONIA, the sort of equivalent of LIBOR plus a margin. That does seem fairly chunky to me, but nevertheless, obviously the board's happy with that. There's an initial asset cover of 2 times, so that means if you had to pay redeem them now, you'd have enough assets to cover that twice. and obviously that goes up and down according to what the NAV does in Chelverton UK dividend. And that's the only kind of threat with these things, that they're normally relatively safe investments, but you have to worry about that NAV volatility. So there we go. The only problem is, I don't think it's going to be very easy for retail investors to buy them. A, we don't know how many shares are going to be left over from the rollover. And B, because I think it's structured as a placing, I'm not sure you're going to be able to participate. There is a prospectus out there. If you can work your way through that and see if you can, by all means do so, or it might be that your advisor can do them. And obviously you will be able to buy them in the secondary market when they start trading, and that's going to be on the 30th of April as the old ones expire. So that's enough news from me. Now we're going to talk to Richard. So good morning, Richard. Very much for doing this.
Morning, James. Good to be with you.
I can get an echo, but I'm not sure what it would be. But well, I won't be talking too much anyway. I shall hand over to you and let you talk your way through the slides that you've given us to sort of introduce what you do at the AIC, please.
Perfect, James. Thank you. Yeah, thank you. It's good to be with you this morning and to have this opportunity. And as James said, if people have questions, then please pitch them in, and I'm sure James will curate those to me later on. I thought I'd start just by going through a little bit about the AIC, the Association of Investment Companies, who we are, what we do, and then talk about a couple of the sort of specific things going on in the sector at the moment. So just starting with the AIC, we've got just over 300 members, about 93% of the investment trust, investment company listed closed-end fund sector, the company's known by various different names. We've got about 186 UK-based investment companies, 79 domiciled overseas, all listed on the London market, covering about 240 billion of assets. And as I said, that covers investment companies, investment trusts. It also includes venture capital trusts, which are a sort of special tax incentivized form of investment company. And from the AIC's point of view, it's the companies themselves that are our members. So the asset managers that sit behind those are not members of the AIC. It's the individual companies themselves. And to the extent that that becomes people, clearly, then the boards of those companies, the non-executive directors of those boards. Our vision is for investment companies to be understood and considered by every investor, and that's quite important words in there is sort of the understood. It's about making sure that people know what an investment company is and how it works, and considered by every investor. We know we're not necessarily right for everybody all the time in their portfolios, but we want to be part of that discussion. And we want to be part of that discussion for every investor, whether that's retail, pension funds, whether it's wealth managers, etc. So we think that members of our association have appeal to everybody within that sort of investor spectrum. And we do that in three ways, which are highlighted in our mission statement, which is to support and promote the long-term benefits of investment companies by engaging with members, investors, and the wider financial community. And effectively that picks out the three things we do. So we support our members, in particular the member directors. We promote the sector, and you'll see quite a lot of the PR and comms work that we do. And we engage with effectively three audiences: our members, investors, including retail and institutional, and then the wider financial community, which is effectively a catch-all for the managers themselves, the brokers, advisors, lawyers, everybody else that's sort of operating around that ecosystem. So that's a little bit about what we do. In terms of the sector itself, I think this chart really highlights the principal challenge which the sector's facing or has faced really for the last couple of years, and which is then shaping much of the activity that's going on in the sector, some of which James touched on in his news piece, but I'll go into a couple of bits in a bit more detail. But on this chart, you can see how discounts really widened out end of 21 into 22. It sort of started with as interest rates moved, and you can see here the difference between what I've described as alternative sector investment companies, so those investing in real assets, infrastructure, renewables, property, those sorts of things, relative to equity sectors, so those investment companies that are investing purely in other listed equity. And you can see how in recent months in particular, we've seen another sort of widening out again between the alternative sector and those equities funds. It's fair to say that the sector doesn't operate in a bubble, so there are some significant macro sort of movements that sit behind this chart, not least the switch in interest rates, which obviously affects the attractiveness of the yields that some of those companies are offering, but also the outflows that we've seen from both UK markets and UK asset management. And if you look at data coming out of the Investment Association and Calastone and places like that, we've seen a significant number. I think it's 44 out of the last 45 months, something like that, where we've had outflows from UK equity funds. We've seen, the UK market, as James alluded to earlier, being undervalued relative to the rest of the world in terms of forward PE multiples and those sorts of things. So as I said, we don't operate in a bubble, but you can see here that that's driven discounts in the sector to levels that we hadn't really seen at all in the last 10 years, and those levels have then persisted for the last couple of years. There are some specific dynamics in terms of the sector itself, and I've highlighted some of the points on this slide. Contributors to discount, so things that have exaggerated the position for the investment company sector. There have been issues around cost disclosures, and I'll come back to that in a minute. We've seen wealth manager consolidation and an increasing focus on the use of centralized buy lists and things within the wealth management sector. And then, so there's some of the sort of additional causes that are perhaps a bit more specific to our sector. But we've also seen then some symptoms, which, lack of fundraising activity, which clearly restricts growth, and increased activism, which again, I'll come back to in a second. So I think the next thing to really look at is the ownership. And this sort of highlights perhaps the wealth manager point in particular. We recently published a report, which you can find on our website, highlighting the ownership of the investment company sector and how that's changed over the last 2 or 3 years. And you can see here, particularly if you look at the alternative investment company ownership lines, how the wealth manager ownership in that sector has gone from 24% to owning 24% of the sector down to owning just 17% of the sector. And that's really been soaked up by institutions who've bought more. Retail, private investors here, you can see, have held steady at about 10%. Retail investors have been buying more of the equity investment companies, so they now own 37% of that sector. 2 years ago, that was 35%. But you can see here some of the shifts and how, as I said, there's been a shift in particular away from the wealth managers into institutions and private investors. As I said, there are a couple of things particularly that I wanted to just highlight this morning. One is cost disclosures, and the other is activism. I think cost disclosures are clearly a cause of those extended discounts, or contributed to them. The FCA published their latest consultation back in December, just before, literally the week before Christmas, and the deadline for that was yesterday, and we've just put in yesterday our submission in response to that consultation, as many others have across the industry. And I think it's fair to say that whether it's the joint industry response or responses from member companies, from investors, from others, as well as ourselves, we're all basically making the same arguments. And I just thought it would be useful to set out the position that we've put in our consultation response. In essence, at a high level, we're asking to be outside of the CCI regime. Now, I'm conscious that the financial services sector loves a good acronym. So if you're getting rid of PRIPS, then why not replace it with CCI? So that's the Package Retail Investment and Insurance Product regime, which was the old European regulation. It's being replaced by the Consumer Composite Investment regime, effectively covering disclosure and all matters relating to disclosure. We think investment companies should be outside of that. We were outside of effectively the scope of these type of regulations until 2018, when the PRIPS regulations came in from Europe. There was no obvious harm as far as investors were concerned prior to that. And we think we should go back to that position, which would enable our members to compete effectively with other funds, if you're an equities investment company, or with trading companies, which is perhaps where the competition is, or where the investors have a choice if you're looking for exposure to infrastructure or sort of real assets. So our principal ask is to be outside of the regime. That's really a Treasury call rather than an FCA call in terms of the scope. If we're kept within scope, then the FCA would have the ability to ring fence us within the regime and effectively not apply rules to us. So we would be defined as CCIs, as a sector, but we wouldn't have the rules applied to us. So that's our kind of next alternative, if you like. And failing that, if the view is no, you're in scope and you should be subject to these rules, then we think that the rules that the FCA have currently proposed within their consultation need really significant amendment. And there are 4 key areas that we would highlight there that need changing. First of all, the proposals would result in the direct regulation of the sector and all that comes with that, which we don't think is justified or necessary. There is the asset manager there who currently has responsibility for producing many of the disclosures, the KID, for example, at the moment, and we think that that should remain the same. There's no reason to extend direct regulation into our sector. Aggregation is the really principal one, and this is what's really hurt the demand from a lot of the wealth managers and fund-of-fund investors. This is where they have to pull through the costs of investing in an investment company into their own ongoing charges figure, which they disclose to their investors. Now, the FCA has recognised that if you are a passive tracker fund, it's illogical to do that. If you think about it, if you invest in a tracker fund that invests in the FTSE 100 or FTSE 250, let's take the FTSE 100, and then you get a new entrant like Alliance Witten goes into the FTSE 100. Do your costs go up as far as the consumer? Well, there's no logical reason why the cost disclosed to the end investor should go up. As the end investor, what you want to know is what's the tracking error and what am I paying the manager who's running that tracker to follow the index. The same logic applies to any other fund of funds or managed portfolio type structure. So we don't think that those costs should be pulled through. It's acting as a significant disincentive to invest in an investment company versus, for example, a trading company where there are no such costs to pull through. And it therefore is distorting the market, and that's got to come to an end. Fundamentally, as the investor, you're paying that asset manager to use their judgment to select investments which represent value and are going to deliver return, and the costs are all wrapped up then in the performance within the fund. You are not paying more on top of what you're paying to the asset manager that whose product you're choosing. In terms of the retail disclosures, there are significant amendments needed there, not least things like the single figure cost disclosure, where retail platforms and others are in a position where they basically add up a lot of very disparate costs. I mean, you really are taking apples and pears and putting them together in one number. If you present a retail client with a cost disclosure that takes stamp duty, platform fees, the ongoing charge figure turned into pound notes, etc., into one, transaction costs and things into one figure, it's misleading, and it doesn't give the investor the ability to really identify and hone in where they're getting value for money and what they're paying for. And the final point, which is a slightly technical point, is that the FCA, for some reason in their consultation, is proposing that the investment company sector should implement the new rules 6 months ahead of the rest of the financial services market, which there is no logical ground for us to front run that, and would cause significant practical difficulties as far as platforms and other distributors are concerned. So as I said, just to recap, our sort of high-level position is we should be outside the regime or ring-fenced within it. Failing that, then clearly we need significant amendment to the rules. And as I say, there are those 4 areas that I would particularly highlight. The other thing I just wanted to touch on this morning was activism. Clearly, we've seen more activism as a consequence of the extended discounts. And activists play a very legitimate part in the market. Fundamentally, they're spotting mispricing or value opportunities that arise from that. And in many cases, they're signalling that to other investors. I think it's fair to say that the recent approach by Saba Capital Management was different. They were seeking to replace wholesale the board of 7 investment companies. replace those with one of their own employees and another nominated director. And effectively then they had said their intention was to look to potentially appoint Saba as the asset manager on those funds, potentially then merging them or whatever, but then using those resources going forward. And clearly that was different from many activist approaches which are focused on closing the discount. Our principal activity when those requisitions, Saba requisitioned 7 companies to have a general meeting, and our principal activity at that point was to engage with the platforms, the regulator, the Treasury, the takeover panel and others. And fundamentally, one of the features that those 7 companies all had was a very high retail level of share ownership within their register. And I think there was a potential view that retail typically doesn't vote, turnout tends to be low, and therefore that has the ability to accentuate the influence of a large minority shareholder. So we were very focused on a high-profile media campaign to get the retail vote out, and then on the back of that identified some of the issues requiring reform. And on the next slide you can see some of the media coverage that this gave rise to. And it was great to see the industry, the media, all the commentators come together and really identify this, but most importantly, raise this in investors' minds and raise the profile of the issue to encourage investors to vote. And we saw a really significant increase in the level of retail shareholder voting. And one platform, it was 55–60% of customers voting their shares on these investment trusts, particularly high, and it was very pleasing to see the big platforms step up and write to all of their customers and to enable voting. Unfortunately, that wasn't the case across the platform market as a whole. There are still execution only or broking services out there who don't pass on the voting rights, don't necessarily even pass on the information, and shareholders who found themselves unable to vote in some cases were charged for voting, particularly in the wealth manager advisor type space where some of the platforms that they use were charging for voting. So we identified a number of things which need to change and on which we're now campaigning, and there's sort of 3 elements to that. First of all, we want to improve shareholder engagement. As I said, the levels of shareholder engagement on the 7 votes that were brought about by Saba's actions were there was high turnout, there was a good level of engagement, but it was almost a perfect storm in terms of the media coverage and the profile of that. So you can't rely on that being the case next time and platforms and others doing the right thing. Part 9 of the Companies Act means that platforms, nominees can, if they wish, pass on information and voting rights. Most of the large platforms do, as I said, but they don't have to, and they can charge for voting. Our argument is that Part 9 needs to be changed so that they must pass on those voting rights, and they should not be allowed to charge people to vote their shares. The other part of the Companies Act which is of relevance here is what's called Section 793. This effectively allows a company to write to platforms or to nominees and get details of the beneficial holder of the shares so that the company can write directly to its shareholders. At the moment, Section 793 requires the platforms to provide the name and address of the beneficial holder. That is widely interpreted across the platform industry as being the postal address, and therefore if you happen to hold some of those 7 companies, you will have received letters, mailings, flyers from the companies through the post. Clearly that process is both antiquated, expensive, time-consuming, not very timely. I know some shareholders contacted me where they'd received the mailing from the company literally the day that the votes or the day of the voting deadline on their platform. So we believe that Section 793 should be interpreted and could be amended if necessary, but I think it could be interpreted without a law change to include the provision of the email address to make it easier for companies to communicate directly with their shareholders. The other thing we've been looking at is the listing rules around independence and the extent to which, at the moment, for an investment company, the independence of the board is defined really in terms of independence from the asset manager, but the extent to which that should include independence from material shareholders, particularly where those shareholders are conflicted, for example, if they're looking to appoint themselves as asset manager. On the shareholder engagement point, we've launched our My Share, My Vote campaign. We've already put in a petition with the government's petition website, which we're waiting to go live. Should be literally any day now that goes live, and you'll hopefully then hear more from us about this. And I would very much urge you to keep an eye out for that and sign and support the petition asking for that change to the Companies Act. And ahead of that, I've written to all of the platforms asking for effectively 5 principles to follow. Firstly, opt every customer in to receive the information. At the moment, only Interactive Investor does that. All the other platforms, you have to choose to opt in as the customer. It's not automatic. Always notify customers about any fundamental proposals affecting their holdings. And we would consider anything where the board is recommending a vote against to be included within that definition of a fundamental proposal, because if the board is recommending, particularly the independent board of an investment company, is recommending you vote against something, then it's likely to be a flag that something is going on that's out of the ordinary. Do not charge for voting, make the information clear and easy to access, and enable efficient, cost-effective communication by providing email addresses to companies looking to communicate directly with their investors. So I'm hoping that some of the platforms may adopt those things early. There's nothing to stop them doing so, but I do still think that we need to change the law so that certainly in the case of passing on the shareholder rights, they're mandated to do so. I just wanted to finish then with a couple of slides really on a slightly more positive note, and boards are being very active in the face of those levels of discounts that we were talking about earlier. We're seeing record levels of buybacks, mergers, strategic reviews. We've also seen quite a significant increase in the level of gearing in the sector. Clearly, as I said, capital raising is very limited when you're at the level of discounts that the sector's at the moment. And a number of managers and boards are increasing their level of gearing to take advantage of investment opportunities that they're seeing. But the industry is undoubtedly reshaping itself, and here you can see that. And you can see how we've moved, and this is investment companies, so it's excluding VCTs. You can see how we've moved in terms of the average size of an investment company as a result. So we're seeing a slightly smaller sector in terms of number of companies, but that sector then being made up of typically larger companies. I think there are a number of opportunities for the sector as well. Obviously, we've got good performance, and here I've highlighted the share price return averaged 82% over the last 5 years. The sector and the structure has the ability to outperform. The structure, as I put here, has many positives, and there will be further corporate activity as well. So from the level of discounts that we've got at the moment, they are going to induce further corporate activity. As well as hopefully people recognising that there are potential opportunities there to benefit from the narrowing of the discount as well as the asset performance. I think there's an opportunity for us to build on the positive sentiment and harness the retail engagement levels that we saw as a result of the cyber activity. Those press headlines that I shared with you a few slides ago, the sentiment behind much of that press coverage was very supportive of the sector, very supportive of the structure. And the other thing, I think there is a potential for reallocation to the UK market going on more globally, and we've seen some reporting of that recently, potentially seeing some of the sucking in of capital into the US and into the Big Seven, perhaps being now reallocated out to back to other markets, whether that be Europe, the UK, emerging markets, etc. So some potential for reallocation to the UK market, which should also help the sector. And as I put on that slide, now is the time for investment companies, in my view. You might say, well, he would say that, wouldn't he? But I think there are some genuinely positive reasons as to why we should think that. There is an increased focus on consumer outcomes, and as I said, the structure has the ability to outperform. We've had an increased appetite amongst government and regulators for consumers to take more risks. You've seen that in some of the commentary around the cash ISA, for example, the FCA's consumer investment strategy, trying to encourage people to engage with investment more. We've seen the Mansion House Compact and other things that are looking to try and encourage pension schemes and others to increase their investment in alternative assets in particular, or productive assets. And again, that provides a potential opportunity. So I think if you've got a focus on consumer outcomes and you've got a drive to try and make savings and investment work harder for the economy to help drive growth, then that's clearly a good thing. And that feeds into this growth agenda. So, Rachel Reeves is under pressure. I think the public borrowing figures out again this morning were larger than anticipated. The public purse is clearly very limited. The government and the public purse cannot do the heavy lifting on this, and certainly not by itself. Capital is needed from a wide range of investors. And the investment company structure is sitting there as a proven method of bridging the gap between public markets and private assets, and a way of gathering capital from a wide range of investors and effectively delivering that alchemy of providing liquidity in what are otherwise illiquid assets. So as I said, in terms of driving growth, the investment company should be very much at the heart of the government's agenda on that front. And finally, we really are a UK success story. When you look at that ownership report I referred to earlier, more than 25% of the alternative sector is owned by overseas investors. Why? Well, in part because they can't get access to that kind of investment through their own markets, because their markets domestically don't typically have an investment company or listed fund structure. And so, this really is a UK success story, and there's an ability to effectively export that structure and investment opportunity to investors and others around the world. So, as I said, I think I really wanted to leave you on a positive note that there is undoubtedly a positive case to be made for the sector. And I think in terms of timing, now may well be the time for investment companies to really start to flourish again.
Those questions, actually. Let's try and group them together. Firstly, the thing about communication. So, are there things that companies can do and the AIC can do to better communicate to existing investors? And how do we go about reaching people that don't know much about investment companies, do you think?
Yeah, so I think I'd pick up two things there. I think one of the parts of my job I love the most is going out and meeting with member company boards and talking to our member directors. And one of the messages I try to get across all of the time is it's about telling our story. And it's about getting to the heart of what those companies are investing in and bringing that to life for the investors. And I think we as the AIC, our member companies and others can do more. You can always do more, arguably, to bring those stories to life. It's about what are the companies that you're investing in within the portfolio? What difference are they making? And what new technologies, or in healthcare or in infrastructure? There are some great projects and some great companies that the sector is investing in and supporting. Bring those to life, and they may, or quite often, they are investment opportunities that particularly the retail investor wouldn't otherwise have access to. So, if you wanted to buy, a bit of SpaceX, for example, then Edinburgh Worldwide has a significant holding in SpaceX. I mean, that's a well-publicized one, but there are lots of investment companies out there who are investing in some really great companies and technologies and things which the investor might not otherwise be able to get access to, or at the very least is being curated by an expert asset manager. And we need to bring those stories to life. And the annual report and the sort of annual reporting cycle is not really the place to do that, and it's certainly not the sole place to do that. We need to have more short vox pop pieces from the asset manager, brief updates on what's going on in the portfolio, those sorts of things. So I think the sector has been around 150 years. It's perhaps inevitable that it takes a little time to get used to modern communication methods, but there's more that we can all do, I think, to bring that to life. The second part of your question, James, was, I think, a really interesting one, which is, yeah, we've run our investment company showcase, and again, I'd urge people to keep an eye out for that on the website. The next one will be on the 10th of October this year. We get several hundred private investors, retail investors along to that, as well as watching online. They're real fans of the investment company structure. I'm sure many of the people listening this morning are real fans and know what the structure offers. They typically have portfolios that may well be made up solely of investment companies. How can we make those fans advocates? One of the biggest reasons why somebody becomes an investor is because of the influence of their friends and family. So I would urge anybody who is passionate about the sector, anybody who is a keen investor in the sector, go out, tell your children, tell your friends, talk about it over dinner tonight, whatever soiree you happen to be going to, and encourage your children, grandchildren, etc., to invest in them and teach them and tell them about what it's about. You're passionate about it, share that passion. I think that's a sort of plea from me.
Is there a role? Well, actually, what it says here is should we do something a bit like the ITS campaign again, but not the ITS campaign?
So we've been looking within our own activity to see what we can do in terms of more lifestyle media and in terms of broadcast. I don't think we need a sort of ITS campaign per se. We have actually just been running a campaign called Future Proof Your Family, and we've been running some predominantly digital ads, although there were a couple of hard copy ads as well within lifestyle media, and it's a question. It's a little bit back to the sort of fans into advocates debate. It's about how you get beyond the current investor base. And we get really good coverage in what I would describe as sort of the mainstream personal financial press. But how do you get out beyond that? And we're doing more. The AIC now has an Instagram account. We're doing more on YouTube and X and all the rest of it, LinkedIn and etc. So and our member companies need to be doing the same. And it's using all of those methods to reach as wider audience as possible. I think the challenge just sharing with the audience, the challenge for the Association of Investment Companies as the sort of trade body is our call to action is a little bit harder. So when we're running the Future Proof Your Family campaign, we're bringing people to our website, we're sharing with them information about the sector, but clearly the buy message, if you like, or the call to action is more difficult when you're a trade body or you're advertising and marketing a structure and a concept rather than an individual share or company.
There's a specific question about data in terms of does the AIC publish data on large shareholders, both the shares that they actually hold and the shares they hold via proxies? Is that something you can do?
We don't typically. We produced for the first time last year, and we've updated it this year. As I said, it was very recently published, an ownership report, which looks at, and I shared in one of my slides, the sort of charts on the different types of owner. So it looks at it in broad terms, and it identifies who the sort of top 10 institutions, top 10 private wealth managers are that own shares in the sector. But it doesn't pull out ownership specifically by company or it's looking at aggregated holdings across the sector. I think it would be difficult for us to surface the detail of any individual company's register. I mean, clearly, if a shareholder holds a material amount that's disclosable, they'll be making the necessary disclosures to the market. But
to what extent is it the AIC's job to improve corporate governance standards or maintain high corporate governance standards across the industry? And what are you doing in that regard?
So we have the AIC Corporate Governance Code, which I think is the only code that's endorsed by the Financial Reporting Council, and our members typically follow that code of corporate governance, and that's what they report against. It's effectively a tailored version of the UK Corporate Governance Code, so we do that. But I think I suspect whoever is asking the question is asking from a slightly broader, almost more sort of principles-based perspective. And we clearly, as the trade association, have a role in supporting, as I said at the outset of my remarks, supporting our member directors, and part of that support is making sure they're aware of their obligations and what's required of them as directors and what good corporate governance looks like and all the rest of it. I mean, one of the things we trumpet as an advantage of the sector is the fact that you have the independent board sitting there representing shareholders' interests, and that's a very fundamental part of the structure and how it operates, and one which we protect very vociferously and very firmly. So yes, we have our role, and yes, we're very keen to make sure that we maintain as a sector the highest possible levels of corporate governance and integrity.
There's a question about the Dividend Hero campaign, which is, I think, has been one of the sort of long-run successes in terms of communicating with investors. But do you think it in any way distorts boards' behaviour when it comes to declaring dividends, and maybe makes them favour dividends over buybacks?
I don't think so. I certainly haven't seen any evidence that it impacts behaviour. I mean, you touched on it a little bit when you were talking about Temple Bar earlier, and you've seen companies cut dividends where it's necessary to do so. So I don't think it particularly distorts behaviour. I mean, what it does do is clearly is highlight the fact that investment companies can smooth their income. They don't have to pay out all of their income as dividends in the way that an open-ended fund does, and that provides a degree of certainty for investors, or some degree of comfort at least, around the income that they might expect to receive. So I don't think it impacts behaviour. I certainly don't think it necessarily, and I haven't seen any evidence that would suggest that it encourages boards to look more at dividends rather than buybacks. I mean, I think, and again, I'd go back to your comments on Temple Bar and their proposals to sort of add a 0.75p a quarter sort of uplift to their dividend. I think, if anything, the sector's done the opposite. Historically, the sector has focused much more heavily on buybacks, and actually we saw record levels of buybacks last year, and we're likely to see even higher levels of buybacks based on certainly the first quarter of this year, or this year. Yeah, and those buybacks are at absolutely record levels. I think we saw 14 billion of capital returned to investors last year through buybacks and various other means of capital returns. So, and that was more than twice the amount that was paid out in dividends. So, yeah, I don't think that would be the case.
Fair enough. Good, thank you. Do you want to just say a little bit about what's on the AIC website in terms of helping people decide, understand what investment companies are, and decide how to choose the right one for them, please?
I mean, the AIC website is an amazing resource, and I would encourage everybody to go there. For anybody who doesn't know, the website is just theaic.co.uk. Thank you for allowing me that plug, James. And yeah, if you go on there, there's a lot under the various tabs. We've got sort of 5 tabs at the top. And you go on there, there's a tab about the sector, and you can find out a lot of information there about the sector and the shape of the sector and things. There's a whole tab called Learn More, and there's a lot of educational material on there about investment companies and what they do and some of the terminology and those things. There's a collection of little videos and things. There's all sorts of material on there in different formats. Once you understand what an investment company is, or if you're a little bit more sophisticated looking to make an investment, there are some fantastic tools on there to help you find the right investment company for you. Not least the sort of search functionality, if you like, the compare investment companies, which enables you to look at all manner of data points, whether it's yield, discount, 1 year, 3 year, 5 year performance, whatever. I mean, the wealth of information on there and how you can filter it. We obviously operate sectors, so you can look at specific sectors. If you want, you can compare different companies against each other. When you click on a company, each company within our website has its own company profile page. That then brings up a whole range of tabs. You can look at performance against benchmarks. You can look at the latest news. You can see who the management are. There's a whole ton of information for each company. And there are a whole number of other tools you can use on there. There's an alerts tool, so you can set up to receive an alert on particular companies. You can set up your own sort of watch list or portfolio, effectively my portfolio. So you can keep a number of companies sort of on watch in a basket, if you like. So when you go back, then you can see those again. So yeah, I would encourage anyone to sort of go along, sign up onto the website, which then enables you to use the My Portfolio functionality. You have to sign up to do that, just so that we know when you come back again. Obviously, it can find the things that you've saved. But even without signing up, there's a whole wealth of information on there to help you find the right investment company for you.
Great, thank you. There's lots more things about communication. Actually, just specifically, if you think about where all the ads are on the tube and what everybody's just talking about in things like Instagram, and it's all around crypto and short-term trading and various other sort of get-rich-quick type schemes. I don't think it's necessarily on our industry to do it, but how do we maybe participate in the wider scheme of trying to educate people as to why they don't necessarily want to put all their money into Trump coin?
Yeah, I mean, there is a fundamental problem in this country, if you just take a step back, around the level of financial literacy, education, and without launching into a particular hobby horse, there's I mean, the problems start right back in school and the whole education process in terms of how we teach people about finance. There's then a whole piece around regulation of what you can say and can't say in different adverts, and what's regulated and what isn't regulated. And I think to some extent, what one might describe as mainstream investments, listed equities, IPOs, listed funds, other funds, whatever, are perhaps a little hampered compared to some other products that have come along and not been regulated in quite the same way. So yeah, I think it's a fundamental challenge. I mean, I have to say, I think it's incumbent on government to some extent in terms of the education system, but then on all of us. And again, I go back to if you're a fan, if you're an investor, and frankly, you don't have to be an investor in investment companies. If you're just an investor and you have a saving habit, an investing habit, whatever, make sure you're sharing that with your children. You're talking about these things. It's not happening in school, so it's got to happen in the home in terms of the guidance you can give. And yeah, I mean, I take your point, James, about the sector and the role of the AIC. I mean, what we are actually seeing is more of our member companies and more of the asset managers who run investment companies actually undertaking direct advertising for investment companies. I mean, I've even seen a number on television running TV adverts, as well as printed media and ads and ads in other places. So are we necessarily on the tube? Perhaps not. But we're certainly more visible and out there advertising more than we perhaps have been historically.
Great, thank you. I think we've covered most things on here, thinking about this. I mean, I suppose just as kind of big picture thing. So obviously we've got the immediate thing with the cost disclosures, and the response to that was incredible. I think I saw an email this morning, I think it was 458 people signed a response to the Treasury, or not, to the FCA, to try and get that sorted out. So hopefully that will work.
Yeah. picked up,
But
James, that we've put out very supportive messages about their submission and the submission of others, and they likewise about ours. I mean, I think one of the key things we wanted to get across to the FCA, and we've actually hosted a couple of meetings with the FCA, with industry stakeholders, is look, the industry is speaking with one voice here. You're getting lots of responses from lots of different people. But the fundamental message is the same from all of these participants in the market, you know, and you need to listen to that. So I think the fact that the industry has come together across a variety of responses, but all in harmony with one another, is a really strong and powerful message.
But if we look beyond that, are there threats or opportunities coming down the line that we need to think about?
Yeah, I mean, undoubtedly, I think if we can resolve cost disclosure, it will undoubtedly help demand, certainly hopefully help demand for the sector, particularly from, as I said, some of that sort of wealth manager, fund of fund type investor who has struggled because of the pull through aspect of cost disclosure in particular. But yeah, I mean, as with any other market, you've got competition coming in from other products. You've got, you mentioned earlier, you've got things like Bitcoin and crypto, and you know, we're all competing for the investor's interest. But I do think there are really some key reasons, as I sort of put on my final slides, as to why the investment company sector both deserves support and actually is part of the solution, a critical part of the solution, to a lot of the problems which economically we have in terms of how we direct more capital towards infrastructure, towards the net zero transition. Just citing two examples, you know, and the investment company sector, it's there, it's proven, it's been around for 150 years, and it's not an antiquated thing. It's always evolved to enable investment into new technologies and frontier markets and all those things. That's why it was started in the first place. But you know, we need some of that support. We need some of that regulatory change to come through to enable us to be as effective as we possibly can. But yeah, there are other threats coming from different product types, from you know, the get rich quick type scenarios, etc. And as we just touched on, the lack of understanding and education is not helpful either.
Yeah, brilliant. Thank you very much, Richard. That's been really helpful. I think we've covered an awful lot of ground, and good luck with everything you're doing. And we'll
Good
get
to be with
back
you
on again another time. But thank you for your time this morning.
Thanks, James.
So next week, something completely different. We've got a panel. I haven't had one of those for a while. And the idea of this one is ideas for your ISA. So we've got three quite different managers, from JP Morgan European Growth and Income, from F&C Investment Trust, and from Temple Bar, who we've also been talking about this morning. And they'll be pitching their fund as a possible destination for your ISA money. And so please do tune in next week and hear what they have to say. In the meantime, have a good weekend and a good week, and we will see you next Friday.